Hello, Inner Circle. More questions that you asked. This session will be a little more informal. I'm just feeling all t-shirty and not formal today. And it's probably because the bourbon shelf behind me is depleted because our move from Puerto Rico means that things are well moving, and that makes me sad. But what makes me happy is to help save you taxes. So let's go at it. Regarding carried interest, can a partnership fund, so an LP or an LLC with multiple members, that originates and invests primarily in short-term hard money loans compensate management strictly with a performance fee in the form of a carried interest in additional units or shares? In other words, a carried interest, also known as a profits interest, what he's really asking is, I have a hard money short-term lending fund. Can I compensate the management with a share of the profits? Their sole compensation is a share of the profits, also known as a carried interest. Assume no other compensation to management, no asset fee or salary. You can do it, but the tax point is not as great as you might think in this example. Now let's start with not taxes. I mean, this is an interesting question because, as you know, I invest in a hard money fund. Generally gives me 18-19% off, got a decent discount converting traditional to Roth. And this is how the management is compensated. Their compensation, first 10% goes to the investors. Anything above 10% is split 50-50 between the people who run the fund, which is what's being proposed here, a percentage of the profits, and between the investors. And so the fund tends to nail 28 to 30% gross return. You do the math, that means the investors are pulling 18, 19, 20%. So this is not at all hypothetical. This is exactly how this fund is set up and works. And why do I like it? Before we even discuss taxes, management is aligned with me. They only get paid if they make over 10%. So I'm on the safe side. I get the first 10% as a preferred investor, but I'm also getting half the upside. I like this as an investor. It aligns well. Now, tax-wise, the normal reason you set up a carried interest is the Mitt Romney, Bain example, or what a lot of the real estate syndicators, which is a little different than hard money, do. Specifically, they get a better tax rate. A good rule when you're looking at carried interests as a general partner, so the general partner is getting 1% of the profit. A good rule when you're looking at a carried interest as a general partner, which is what we're doing here, is what is being carried. The object is that if whatever is being carried is taxed more favorably than a W-2, I want a carried interest for tax purposes in addition to motivational purposes. Let me repeat that. If the tax treatment of whatever is being carried is more favorable than the tax treatment of a W-2, then this is a good idea for general partners. For example, if I charge a fee, and I can say my fee is X% of profits, but it's paid to me as a fee. It's not structured with me being a partner, with me having a profits interest, then that fee is taxable as W-2 income. You pay ordinary rates and you pay Social Security or self-employment tax, pretty much the highest possible rates. Let's switch it. We have a real estate fund, and to be specific, one that has one large rental project. I want to be compensated as the manager on a percentage of the proceeds or the percentage of the profit. Why is that better for me? Why? Because the underlying rental taxation is better than W-2 taxation. Rental income is taxed at ordinary rates like W-2 income, but there's no Social Security or self-employment tax. Furthermore, rental income is passive, and so it's easier to offset with passive losses. When the property sells, what do we have? Mostly long-term capital gains, maybe a little bit of recapture. So again, as a manager, would I rather receive the equivalent of W-2 income as a fee, or would I rather be a partner, a profits partner? What does that mean? A carried interest, in tax language, a profits partner. Why do we call it that? You're a partner, but only to the extent of profits. You're not entitled to any of the capital. The other investors, the limited partners, put the capital in. They're entitled to a return of their capital. As a general partner, you're just splitting profits, and that's how you get paid. Well, here, if you split profits on the sale of the rental property, most of that's long-term capital gain. and there's no self-employment or Social Security tax. So from a tax standpoint, that is superior. Now let's look at this example. How are hard money loan proceeds taxed? Just like a W-2. Now you still may want to structure it as a carried interest. There's not necessarily, though, a tax advantage because the tax rate on hard money lending is the same as a W-2. It's ordinary rates, not capital, and there is self-employment or Social Security tax, which there are ways to reduce that. That's a bunch of separate discussions. So there's not an inherent tax reason to do this, although I'll give you a few angles that might convert that ordinary income into something much nicer. I assume the future interest or profit otherwise earned going forward on the carried interest shares or units after those shares are allocated to management would still be taxable income. But is there a way to avoid that as well? I mean, people always have to ask. So I always kind of shake my head a little. You have to ask, but the most common question I get is, I'm receiving cash. I would like it to not be taxable. Tell me how. Usually that's done ahead of time. Usually that's not something we can, almost invariably, that's not something I can work with once the money has arrived or is about to arrive. So do I know a way to make this completely tax-free? No, not even running it through there are problems running a general partnership interest through a Roth or a 401k that has to do with prohibited transactions. So using an IRA, using a 401k directly probably won't work. However, this is a great candidate for a rollover business startup, a ROBS. Could you be the general partner through a C corporation owned 98% by your Roth 401k, 2% owned by you? Sure. 21% tax rate on the corporation. The money gets distributed to the Roth 401k. It's not taxed again. Puerto Rico, there are plenty of hedge fund managers here. Hedge fund managers are doing what's described in this slide, usually just at a larger scale. That fee income in Puerto Rico is going to be taxed typically at 4%. Now, if the income from owning a piece of a partnership comes through as capital gains, there's potential for it to be taxed at 0%. Puerto Rico has two separate laws. What used to be Act 20, 4% tax on services income. Act 22, 0% on certain capital gains, certain interest, certain dividends, certain royalties, and that's the trick. Now, it's all been re-encapsulated into a new law, Act 60, but you really do have to live here. A lot of people try to find ways to not live in Puerto Rico or live here for a very short amount of time. That doesn't really work. So you have to be really willing to live here. Without going into details, because it would be TMI, you have to be careful about assuming capital gains generated from this arrangement would be taxed at 0% in Puerto Rico. And that's because there are income situsing rules. Only income that is considered to have arisen in Puerto Rico is subject to Puerto Rican law. If it is deemed to have arisen elsewhere, then it will be taxed elsewhere. For example, you have this syndication that owns a rental property in California. Where are the capital gains taxed? California or Puerto Rico? California. I don't see much of a way around that, but there are specialists. Maybe they know a little more about that than I do. So you might look at Puerto Rico. QBI, qualified business income deduction, that does lower your effective rate. So I kind of lied when I said that being a partner in a hard money lending fund is the same tax rate as a W-2. You are going to get about a 20 to 25% discount. Why? If you structure it properly, income passing through to the partners, including you, your carry, whether it's 20 or 30 or 40 or 50% after the investors have been paid 10%, whatever it is that you're getting, will pass through, and if you structure it correctly, would be eligible for the qualified business income deduction, which would drop your ordinary tax rate by about 20%, sometimes a little bit more. So there are some ideas to lower the income should you choose to structure your GP interest in a lending fund as a carried interest. Next and last question on this, as to carried units, is the 3-year holding period test. Now, in certain cases, and this gets really deep into the carried interest rules, we did an entire topic on it, which I will probably revisit in the next couple of months. Carried interests, if you want to get the long-term capital gain, you have to be, as the general partner, You're a partner, but your partner is in exchange for sweat equity. So you're given a profit partnership. You share in the profits. You're a partner, but all you get are profits, no return of capital, because you never contributed any, at least not as a general partner. So you partner, you get a share of the income as a partner. If you want long-term capital gains rates, you have to hold both the asset and your interest in the entity for at least 3 years. Now, that's a general rule, subject to a lot of exceptions. Here, we don't have to worry because capital gains aren't in play. And the reason is this kind of operation doesn't generate capital gains. Lending and bringing back interest income or fee income generates ordinary gains. So we're not really worried about the 3-year rule, but I'll answer the question anyway. If the 3-year holding test were relevant, is it tested on an annual basis? For example, if I invest December 31st of 2026 and I sell January 2nd of 2028, I touched 3 years. It's an annual test. We're awesome. Not how it works. It's by the day. So basically whatever 365 times 3 is, that's your number. You're going to count by the day to meet the 3-year rule. And once you've held the asset for 3 years, it's capital gain eligible. Now, do understand you have to read the statute very carefully. That's more than I wanted to go into on this question. I didn't want to make a whole seminar out of it yet. But do understand that not all assets that generate long-term capital gains have to meet the 3-year rule. That's where you have to read the statute very closely. For example, Section 1231 assets do not have to meet the 3-year rule. What's a classic 1231 assets? Most non-commercial, non-triple net leases. So a lot of real estate funds don't have to meet the 3-year rule for long-term capital gains to be good. So we'll go into that on a future seminar in detail, but this is, I think, enough to answer the question and then some. My primary real estate rental LLC, BIP LLC, owns a piece of land financed on a credit line that I would like to improve with a septic system, electric, water, and a building for an income-producing rental unit utilizing a self-directed Roth. All right, now my understanding is my primary real estate LLC, you own this. So you want to use Roths to do something, and we're going to see that in the details that come. But to be clear, my read of the question, so that you can correct me if my read is mistaken, is that the real estate rental LLC is not your Roth's primary real estate entity, it is yours. You own it. And so then the question becomes, Great Western Bank has a program for non-recourse loans to IRAs for improvements. I spoke with them last year about doing this on a different property owned by Big Sycamore LLC, which is owned by the self-directed IRA, which would be appropriate because if you borrow on something owned by the IRA, can the IRA basically do the deal? Borrow, improve something on land it already owns? Well, yeah, but that's not what's being asked here. Here's what's being asked. I have a traditional IRA in the market that I could roll into self-directed Roth. Can the new self-directed Roth buy this land from my LLC, or is that a prohibited transaction? That's as prohibited as it gets. That is just a direct prohibited transaction, and there's no way around it. No cleverness of I'll transfer the property to my cousin or my financial friend, and then my IRA will buy it from them. That doesn't solve the problem. It actually makes it worse. The only approach that might work if you're feeling really aggressive would be you keep the land and the IRA finances the improvements and makes the profit on the improvements. What's the problem? That probably is also a prohibited transaction, just less directly. Remember, anytime your IRA or 401k does something that somehow benefits a disqualified person is a prohibited transaction. So the IRA and the 401k are not allowed to benefit, for example, you or your LLC. Now, people oftentimes come back with, but this is a great deal for the Roth. It's not benefiting me. It's benefiting the Roth. The Roth is getting the benefit, not how the courts look at it. The courts don't care if it's a great deal for the Roth. The courts don't care if the IRA or the 401k benefits. They ask a narrow question. Did it somehow benefit a disqualified person, such as the owner or an entity owned directly or indirectly 50% or more by the IRA or 401k owner? And here I think there would be a clear benefit. It increases the overall value of the land, increases its liquidity, increases the odds of its selling. So by and large, I think you have a direct prohibited transaction, just no ifs, ands, or buts, 100% likely prohibited transaction if you buy the land from your LLC using this account, this traditional IRA that you convert to Roth. And even if you were to build the improvements on it with IRA money, I still think you probably have a prohibited transaction, which with an IRA is very dangerous because it destroys the whole IRA. By the way, if you were to do something like this, I would move the traditional IRA money to a traditional 401k, if you're eligible, a traditional solo 401k, and then convert to Roth. For reasons I won't go into on this slide, but are available elsewhere in the Inner Circle materials, I think 401ks, and especially solo 401ks, are way better for self-directing than IRAs. 401ks are just superior tools for self-directing. Scenario 2, I have an existing Roth invested in a private lender making 9%. Can this exiting Roth buy the land? No, same issue, right? You're just saying, well, here's this other account. Can it do the same thing? And the answer is no for the same reasons. I've been trying to find ways to grow my Roth exponentially. You've come to the right place. There's a lot of networking on creative, legitimate, and some creative, not so legitimate ways of doing that, right? This is the holy grail. I want to grow my Roth super massive fast. And that's a big popular topic. I think you'll see it in the Q&A. I think you'll see it on the discussions, and I think you'll see it on the discussion board. My CPA is always gray on prohibited transactions and aggressive growth strategies. Well, that's fair. I think the more important question becomes, is your CPA well educated in such matters? I am. And when I don't know something, I go find out. One nice thing is the Inner Circle has been trending in the direction of bringing on more CPAs, more tax consultants, more enrolled agents, those kind of people. And most of them are pretty darn sharp. And so they'll probably end up generating some business here because I limit what I do and they do things I don't. Preparing returns, for example, being your hired hand year after year, for example. I tend to be a lot shorter term in terms of the hours that I do charge. So there's the answer to your questions. Probably not what you wanted to hear, but what you needed to hear. Since Roth conversions cannot be undone or recharacterized, if our independent appraisal is rejected by the IRS during an audit, what is our legal defense plan to prevent a massive retroactive tax penalty on the full undiscounted asset value? Well, first of all, it's very rare when you have a discount valuation that the IRS says you get zero discount and that the court actually agrees. Usually they'll disagree with the amount of discount. They might try and nudge it downward. Some of that depends on how aggressive you were to begin with. Some of that depends on the credentials of the person doing the appraisal. One of the things you'll hear me talk about, most people get a light appraisal on the theory it's cheap and I won't need someone with massive credentials. For example, we have a CPA who does appraisals. We have a lawyer who does appraisals. And I think they know what they're doing. Their prices are very good. They're light appraisals. Now, if you actually get dragged in the tax court, or more properly, you drag the IRS in the tax court, it's usually the taxpayer who does the suing, then you want somebody with more credentials, somebody with all the appraisal training and so forth. The problem is those guys are more expensive, usually $5 to $7 grand on an appraisal. So most people go light, and then if push comes to shove, which is fairly rare, they bring in a heavy appraiser. Usually there's a negotiation. If the IRS doesn't like your value, in the unlikely event there's an audit, because these are fairly infrequent audits on this kind of thing, they don't generally say no discount. They generally say, all right, let's talk about how heavy the discount should be. Oftentimes there's a negotiation to avoid litigation. So what's the legal defense plan? I already have the law. I've laid the law out elsewhere in great detail. Is discounting legal? It is. In fact, the IRS uses it to its advantage when it wants to. For example, on charitable contributions, the taxpayer wants to have a very large value, and the IRS wants to see a small value. And we've seen case law where the IRS uses exactly, and I mean exactly, the same techniques we use on Roth conversions to get a smaller value. In other words, they'll tell the taxpayer, your entity, we need to have a way bigger discount for lack of control. We need to have a way bigger discount for lack of marketability. So when the incentives are reversed, the IRS applies this technique. So legally, I'm not worried about it. It comes down to the valuation. And the valuation is almost never a, sorry, you get no discount type of thing. So best you can do is have a good appraiser, decide if you want to go light, cheaper, not likely to be looked at, but if it is, less credibility, more chance of pushback, more chance of a penalty. Usually in the modern day and age, I think we can avoid a penalty unless your appraiser was nuts and did something really extreme. And I guess that's part of the idea, is to have a credible person, be aggressive. I want them to put their thumb on the scale for you. Just the same way when you do a property tax appraisal. When you do a property tax appraisal, you want the appraisal to show a lower value, but not so stupid that you can't justify it. And the appraiser knows that. They're going to put their thumb on the scale. We don't want them to put their elbow on the scale. So what's the defense plan? Well, if we get audited, we push back and say, your appraisal's wrong, our appraisal's right. That's it. I'd consider donating money to an entity that I own or control. If that entity could do philanthropic things, it could buy the notes or create seller finance opportunities and pay me a salary. I think here's what's being asked. This is sort of a vague question. I think what's being asked is, and I get this a lot, I want to set up a nonprofit because nonprofits don't pay tax. And if they don't pay tax, that means tax savings. And I want to run my business through the nonprofit. Tell me how. It doesn't work. It's very rare, very, 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 very rare for a nonprofit to benefit you. If it does, it might be in some indirect way. For example, a real estate nonprofit is able to get first bid on land bank properties. But then you run into the issue of, is it really a nonprofit? The IRS can be hell on wheels with, wait a minute, you have a nonprofit not to really help people. You have a nonprofit not because of the charitable impulse. You just have it because you want to buy the property cheaper and pay yourself a bigger salary. That's not really a nonprofit. That's actually very much a for-profit. If you're looking to set up a nonprofit or a charity or any kissing cousin for purely tax reasons, it's not going to work. It's very, 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 very rare that I've seen that work well. The numbers don't add up because the charity or the nonprofit actually has to get enough that you could have saved more taxes by doing this in some other entity. Paying yourself a salary is the most expensive way to get paid. So the only reason you would do this is if you, honest to God, really want to help a nonprofit. Let's say there's a church you like or an art museum, one of those things, and you set up a C corporation that is owned by the nonprofit, and you take a reasonable salary because the IRS looks for you gutting the corporation by taking all the value out of it. You want to see, that may be the way to do it. That is the Mozilla model. If you look up Mozilla, it is a nonprofit that owns a C corporation, and the nonprofit actually does get most of the income. This is not a structure designed for Mozilla's founders and creators to get some sort of secret special tax benefit. Now, I know you've probably seen a lot on the internet about, no. I've seen advertisements, nonprofits, people are advertising structures where it's a nonprofit and I can make huge tax savings by having the nonprofit own my business. That is a lie. That is a flat out falsehood. People are going to prison over that, and I can back that up. Now, I'm generalizing. I haven't seen the structure, and I probably won't look at the structure because I think 900, really anything that doesn't follow the Mozilla model, I haven't seen function well. If it doesn't follow the Mozilla model, it doesn't function well. If it's just a nonprofit that's somehow designed to save you money, once I dig in and look every single time, it's just false and wrong. And that's a strong statement. I can back it up. Now, am I going to argue with a promoter? Sometimes I have a promoter when I answer these questions say, I'd like to debate you. Okay, why would I do that? To prove your word. I don't really care what you think of me. I'm not going to spend hours debating you. I used to, by the way. I used to debate various promoters, especially of trust schemes and charitable schemes, and I've beaten enough of them that I view it as a waste of my time now. So I won't debate them. I would just say, be very careful with this. There's a lot of it being promoted. It doesn't really work. Now, When does a nonprofit have some tax benefit? You have a business, for example. You're going to sell the business, you donate it to a nonprofit. But here's the key. You either donate it to the nonprofit, or more commonly, you sell it to the nonprofit on a note. If you sell it to the nonprofit on a note, you get paid on the note. You have a deferred tax, the note defers the tax. You get interest, maybe principal income for whatever number of years, 5, 2, 10, 30, whatever. The nonprofit owns the business, sells it, typically doesn't pay tax, depends on how it's structured, but that money doesn't circle back to you. It goes to the charity. It goes to the charity, except for what? You sold the business to the nonprofit or to the charity. It can cycle back principal and interest payments, but not more than that. I've seen the charitable LLC scam that's put out there. I think it's also been called charitable bank, where a nonprofit technically owns your business, technically on paper, but in reality it doesn't. Why? All the money circles back to you, usually through loans or through your being able to use property it owns for free. IRS is all over that. So I would need more details, but with that said, I don't think it'll change my answer. I've seen enough of these, what I think you're asking, because the question is kind of vague, but I've seen enough of these charitable nonprofit tax savings devices, and I've never, ever seen one work purely for tax purposes. Now, if you have actual charitable intent, you're not doing it just for tax reasons. You want the charity to get a lot of the money. But understand, when you do the math, what are my tax savings compared to what the charity gets? You always have less tax savings than what the charity gets. Right? You can minimize what the charity gets, but the math always works against you financially. So if you're looking to do, again, charitable or nonprofit planning purely for tax savings, look, I'm going to wink, say I want to help the charity. I don't really care. I want the money and I want the tax savings. That's not going to happen. On the other hand, if you really have a charity you truly care about, you might as well get some tax benefits while you are what? Giving it a lot of stuff, giving it a lot of money, giving it a lot of property. You are giving it to the charity. No. I want to give it to the charity, but it really comes to me, if that's what you're after. On the other hand, if you're legitimately looking to help a charity, probably it's going to be the Mozilla model, probably it's going to be a charitable remainder trust, maybe a charitable lead trust. Some of that is a bit more on the legit side. And that's not just one seminar. What I just described is probably about 3 or 4 seminars of 2 hours each. Are there any assets that should be kept in a revocable living trust in the trust's name besides real estate? Currently, all other assets have beneficiaries named. Well, let me go through the list. I think you have the right idea. If an asset goes straight to a beneficiary based on the law or based that it's held in a trust, then you don't need to put it in a living trust. Any assets that don't go straight to beneficiaries, where you would have to, when you pass away, title would have to go through probate, that's what you want to make sure every single one of those, every single one is in the revocable living trust. If you miss one asset, you forget to put one asset that should be in the revocable living trust, now you got to have probate, or well, not you, but whoever's left behind has to have probate. So if the asset transfers outside of probate, bank accounts in some cases, certain kinds of real estate, IRA beneficiaries, you don't need to have it in one of these trusts. So let's take a quick look. The list I'm about to give you is in general. This is a very state law sensitive topic. You need to look locally to how your jurisdiction treats these things. So I am generalizing. Things that usually transfer directly, no revocable living trust needed to avoid probate. Your retirement accounts, life insurance proceeds, HSA proceeds, bank or credit union accounts with a pass on death or survivorship designation, brokerage investments accounts with a transfer on death designation. You can go through the rest of the list. A lot of it's pretty well known. These assets usually do not transfer directly, so they really need to be in the revocable living trust. Real estate, if it doesn't have a transfer on death deed, and that's especially true for real estate out of state. Let's say I live in Florida and I have everything in a trust there, and then I have property in Tennessee. I don't put it in the trust. Congratulations, you have to go through Tennessee's probate process, or whoever's left has to go through Tennessee's probate process. So you would want to put Tennessee property into the living trust so that it's not dragged into Tennessee probate. Interests in a business, LLCs, S-Corps, C corporations, usually do not transfer. You do have to make sure to look at the operating agreements because those can interfere with either your ability to put it in the revocable living trust or getting to the result you desire. So the operating agreement for those entities needs to be compared to what you're doing outside of the entities in your will and in your revocable living trust. S corporation stock, there are some restrictions. If you're going to put that in a revocable living trust, it has to be done in a certain fashion. TMI, I'm not going to go into the details. I just want you to know S corporation stock owned by a revocable living trust has to be held, titled in a certain way, and there's a certain amount of time for the trust to dispose of it. Private syndication interests typically don't have a transfer on death provision. Sometimes in some places they do. Other items that don't always transfer with a with pay on death or transfer on death. Non-retirement brokerage accounts. Sometimes they transfer, sometimes they don't. You have to look and you have to periodically update it. These things change. For example, there are so many cases. I wanted to transfer to this person whom I love. I no longer love this person. I forgot to put in there, change the beneficiary. A lot of case law on it. And guess what? Most of the time, it transfers to the person that the paper says it transfers to, even if it was just because you forgot to put someone else on there. It's a well-known recent case where an old girlfriend from 30 years ago got $1 million 401k account, wife of the deceased, and the kids were not happy, but the law was very clear. It goes to whoever is on the beneficiary account. But some of these accounts, again, in some places, some accounts have beneficiaries or transfer on death provisions. In some places they don't. Prom notes, private mortgages, loans receivable, definitely tangible personal property. Things like art, automobiles, antiques, jewelry. You really, really, really want that titled to the trust. That's the classic, so sorry, got to go through probate. Oil and gas interest and royalties, that's just real estate. Sometimes it transfers on death, sometimes it doesn't. Depends on which state and what kind of deed or other transfer mechanism you have in hand. Safe deposit box contents, crypto. These are all examples of things that should be in a revocable living trust. I have a traditional beneficiary IRA, that's an inherited IRA, of around 700 grand. I'm on year 3 of the 10-year withdrawal time. How do I avoid some of the tax on what is coming out by moving it around or place it in other investments once it's withdrawn? This is kind of a more generic question, right? The question I get is, I've got income coming from X. I'm selling something. I've got traditional IRA coming. I've got money coming in whatever form. And then there are a million different ways it comes. How do I not pay tax on that money? Well, it's usually going to boil down to generate a lot of losses, generate a lot of deductions. And that's where we get into, okay, genius, tell me how. A lot of different techniques. Some work, some don't. Some work for some don't work for others. For example, the one we're seeing a lot about, and I recently answered a detailed question on is, I know I'll go buy a bunch of equipment and take the bonus depreciation. And that's being heavily promoted by people who have no idea what they're doing. By the way, that normally doesn't work. So I don't want to go through the whole panoply of options and for a specific slide, or I'll do it over and over, but it's the usual things. Real estate professional status on rentals that produce losses, short-term rentals, but what's the key? You have to want short-term rentals and be good at them. You have to want rental property and want to spend enough time on it to qualify for real estate professional status. There's always a trade-off. There's no magical answer. There's no, I can suggest things, and really what you want to do is follow the inner circle. And as we discuss all of these different techniques to generate deductions, they apply generically across the board, including to this situation. So in terms of generating deductions or generating losses that offset the IRA, it's a massive list. I'm not going to go into it now because it's a much larger, not topic, but many, many topics. Now, one thing you can do to delay the pain and maybe even defer some, absolutely eliminate the pain. One is timing. When the assets are at a lower value, I don't know what assets are in there. But let's say you've got oil stock and oil drops and the oil stock drops. That might be a good time. That's good timing. If you have notes in there and somebody defaults on a note, the note is worth considerably less when it's in default. You can get it valued at a lower value. So there's a timing matter of, depending on the assets, If there's a dip, that might be a good time to distribute. And then the discounts we talk about. So we talked about discounting when you're converting from traditional to Roth. If the traditional IRA, the beneficiary inherited IRA, owns interests in an entity that has a lack of liquidity, that has a lack of control, you might start distributing that interest at a great big discount, the way we've discussed. It's the same thing, right? Owning a piece of an entity in which you lack control or in which you lack liquidity is one way to reduce the value of an asset. Now, to be clear, am I telling you, here's what some people just heard. John told me I need to go invest in a shitty investment and it'll be an LLC or an LP and I'll have a lack of control and I'll have a lack of liquidity. And I should do this in order to pay less taxes, and then I can transfer assets out of my traditional IRA at a lower value. That's what John told me to do. Now, first invest in a really good investment. I've seen, unfortunately, people focus on the taxes and they want a nice discount on their traditional to Roth conversion. And so they go invest in crap where they don't do their due diligence. They're in such a hurry to get the tax break. They do lousy due diligence, they invest in crap, and then they lose the money and taxes are no longer a problem. That's not what I'm suggesting. I'm just telling you it's one way to do it. So if you can find a good investment that happens to be in a multi-member entity, then there might be a discount, could be a decent discount for investing in the entity. Because again, when the LLC shares you invest in have a low value, for all the reasons we've discussed many times, that's the distribution value. And so it reduces the tax you pay when you distribute from this account. So there are some ideas. That's all I got right now. I purchased a commercial building in a qualified opportunity zone in 2019, nice and early. I completed the required upgrades. Good, so we're in compliance. The down payment was 1031 money from sale of another commercial building. That sounds a little odd to me, but I'm not going to go into the details because usually if you do 1031, you don't need to do QOZ and vice versa. So probably a story there. 2026 is the year I need to pay 90% of my original deferred capital gains. True. Are there any new laws I can utilize to work around the 2026 taxes? And if so, that would still give me the benefits of the 10-year hold. Because when you put capital gains into a qualified opportunity zone fund, which is what she's done, you get two benefits. The little benefit is the deferral, but now the deferral is coming to an end. It's 2026, it's time to pay. And she's saying, I don't want to pay. Is there a way around it? But if there's a way around it, I still want to keep the big benefit. And that is, I've already had assets in this thing for 7 years. I'm 7 years to the 10-year clock. It's important to have assets in a QOZ for 10 years. Why? Once you have assets in the QOZ for 10 years, now they can be sold tax-free, and that's the big benefit of a QOZ. And so what's the problem here? Yeah, she can trigger an inclusion event. She can make certain distributions. She can sell her ownership interest in the fund. Depends on the details. That's way too much detail that I'm going to go into, but you create what's called an inclusion event. It could be selling the asset, again, a distribution. It could be selling the interest in the fund. There are a lot of ways to create an inclusion event. And that will create a capital gain. And that capital gain can be rolled into a new opportunity zone fund, which gets you another 5-year deferral. What's the downside? That does lose you. It starts the clock over. The 10-year clock starts over. I spoke to a client yesterday who doesn't care. So he has some interest in rolling to an opportunity zone fund. If what? If it's a good investment. In other words, he wants to roll assets by distributing maybe to a new opportunity zone fund. So we may be able to take the same assets and make them qualify, maybe not. That's where you talk to a guy like Ashley Tyson and get into the details. I know how to use QOZs, but I'm not expert enough in them to go into that kind of detail. Now you have to talk to a true expert. There are different ways to trigger an inclusion event or capital gains, and it creates a capital gain that you can then roll over into an opportunity zone fund for 2027, and that'll get you a deferral. Now, in the case of the client I'm talking about, he intends to hold the property for 20, 30 years. So he may not care about the 10-year clock starting over, assuming what? He can preserve the qualified opportunity zone status of the property. That's where you get into details. Because remember, We don't want to destroy the fund. We don't want to distribute the property, because if you do, now it's not in a QOZ where eventually it'll be tax-free. So the key is to trigger an inclusion event while keeping the 10-year clock for the property, but the clock starts over. And again, I won't get into the mechanics of it, but have I found a way to create an inclusion event which allows us to defer the gains and keep the 10-year clock from starting over? Not so far. Now, the QOZ community is all over this. They're talking about it, and they're guys that this is all they do. I follow them, but I haven't seen anything yet that gives us the perfect answer of we can get a deferral, we don't have to pay our taxes in 12/31/26, and we keep the 10-year clock going. What I am seeing people do, there is another, again, this discounting concept comes up so much in tax law. If you look at QOZs and how much tax you have to pay at the end of 2026, how much income is generated at the end of 2026, it's the lesser of the tax you're deferring or the fair market value of your ownership in the QOZ. Let me repeat that, it's really important. The tax you pay at the end of 2026, the income it generates, is the lesser of the amount of income you have deferred or the fair market value of your interest in the QOZ. Well, discounting rules apply to valuing your interest in the qualified opportunity zone fund. The fund is usually an LLC or an LP, sometimes an S-Corp. I haven't really seen C corporations. And if there are other owners, there's probably a discount. In other words, what's that thing worth? Less than the assets it holds. Why? Because there's the discount for lack of control, lack of liquidity. So you may pay the tax in 26, but you may pay on less income because we use discounting to reduce the amount of income that shows up at the end of 12/31/26. And this is just a restatement of what I just said. So you may gaze upon the slide. There are different ways to trigger an inclusion event. They all have their own different consequences. You might gift an interest in a QOZ, yada, yada, yada. Bottom line is, there it is. And you want to talk to someone who's a technical specialist. By the way, I would expect to see Ashley Tyson in the group. I think he's going to put on some presentations. He will answer some questions here and there. Now, will he answer all the questions for free? And you can send him a detailed, take a picture of your situation and he'll go through your tax returns and give you a precise answer? Of course not. At some point, he's going to bill you, as well he should. So Jack Miller, a few years ago, about 40 years ago, told us to have our real flipper C-Corp buy a house to use as a corporate headquarters and require me as president and my wife as secretary to live there rent-free to conduct the business of the corporation. The C-Corp therefore pays taxes, insurance, and utilities. I just pay for the food. The law has changed a lot. You can't do this anymore. This is the convenience of the employer rule. If you live in a residence for the convenience of the employer, the business could own the residence. The employee is living there because the employer requires them to do so. And the case law has tightened this up. There has to be a true business reason, not just, I have a document and my C-Corp said, you must live there. We require it. It must be so. No, you have to show an honest to God reason and a strong one. Classics, you have a ranch out west and it's huge and somebody needs to be there constantly and that person is you. That'll work. There's some case law on that. You might get away with an apartment building and you are the manager and the manager is required to live on premises because that's normal in the industry. And so you would still get to treat most of the apartment building as not a personal residence. Now, the little portion you live in would be treated as a personal residence. That does have consequences, but living there, the value of living there would not be taxable to you. But by and large, the way this technique used to be promoted, obviously by Jack years ago, the case law has tightened it up. In fact, I'll share a case with you guys later. There was a guy out of Hawaii. So when I talk about the case where the Hawaii guy went to prison, the Hawaii guy, one of the things he did is this. Now, this alone, I don't think got him put away. There was a pattern, and I want to walk through that when we go through the case. But one of the things he did is he bought a house, said it was for the business and for business meetings and for business travel. And then he had his 3 kids live in it. and they actually subleased it and kept the money for themselves. Now, he did a lot of squirrely stuff like that, all in one C corporation. He went to prison over it. So there is a point where if you do enough of this, you cross the line. Here, just doing this, I don't think will get you in prison. It does look sketch. It does get an IRS agent to look at it. And again, no, I don't know a workaround. And unless it's a legitimate situation where a normal employee would be customarily required to live in the property, at which point you might get away with it. But you still have some issues under Code Section 280 Cap A, and there are exceptions. It has to be carefully structured. What does Code Section 280 Cap A say? If you have 14 days of personal use of the property, you can't take a loss on the property. Now, there are exceptions to 280 Cap A for what? When the property has employees in it and they are truly there for the convenience of the employer. It's not just that you wrote down, I need you to live there. C-Corp says I got to live there. I have no choice. I have to do it. No, there has to be a strong reason in reality. And usually what you look to is custom. For example, are ranch hands customarily required to live on premise? They are. Why? Because of the remoteness. There's just really not many options for them. So you got to look to custom. Could you arrange something where it's customary and it's truly required, not wink, wink required, not required on paper, required for real, and it has meaning. It has meaning. It affects your life. For example, being required to live in an apartment building and manage means you actually have to manage. You can't just say you're the manager and someone else does everything and I was required to live there because I gave myself the title of manager, but I'm not really the manager. I just wanted to say I was so that I could live in my own property for free and my C-Corp or some other entity pays for the property. That's not going to work. That's a substance over form issue. So it works. I've seen very few taxpayers actually pull it off. This, in other words, is I've seen it, and I've seen people try a little harder, but in general, this doesn't really work well for most people in most cases because we can't engineer a situation that is acceptable to them as a personal living circumstance and a situation that is also a business necessity where you really have to require someone to live there. Haven't seen it. It's rare. It's rare that taxpayers can successfully pull that off. So you're setting up a startup and it has no value because it is still in development. When should this be formalized into a C-Corp for a ROBS setup? I'm building an SaaS, so software as a service project. I was doing this in my existing S-Corp because it had no value or revenue until it gets up and running and rolling it over to a ROBS setup. You should be able to still roll it into a ROBS. We've had this situation before, and I'll quietly, not here and now, but if you email us, I'll send you to a lawyer who can help make it happen. Very similar. Actually, it was a client who had a software as a service project, had put some money into it, got an appraisal done, and the appraiser showed that it was worth very little. Now, it can't be worth zero, but it has to be worth very little. And we were able to roll the pre-business, let's call it, into the ROBS. Little over my head in terms of the precise details. I mean, we did go through it and discuss it. I was involved in it, but we had a specialist do it. And it kind of makes sense that you can do it. I mean, ideally you start it in the ROBS in day one. So the only really vexing part is, the only risky part is, all right, you've already put money into it. Does that money count? For example, can the IRS force you to be a partner with the ROBS? The ROBS put in X, you put in Y. Could it force you to be a partner? It's an argument. That's what makes it aggressive, that we're saying, well, no, the business has very, very little value. It hasn't started. It relies solely on you. The sooner you move it into the ROBS, the better. So it is aggressive. You want to get the statute of limitations started. And if you want a referral for someone who can execute on that, I'd be happy to put the two of you together. But yeah, I think you can do it as long as you're not super risk averse. I don't think it's reckless at all. I have a half-assed method, there's honesty, of keeping some of my appointments in a physical day planner and a pad in my shirt pocket to substantiate my mileage. I failed miserably a long time ago on keeping detailed records. My two vehicles are C Corporation owned. Each month, my C Corp pays 5/7 of my gas and repairs, 5 weekdays versus 2 weekend days. It's not much, $300 to $500 a month. Will the IRS care? Oh yeah, they'll disallow it. If you get a nice auditor, they might negotiate or work with you. Most auditors would simply say, you are required to keep a mileage log. And now with modern tech, it's an easy thing to do, and you haven't. And so they can just disallow the entire write-off. In fact, given just how round this is, I think they probably would. I don't know how much they would compromise. And look, it's a trade-off. It's a trade-off in terms of, in order to get a certain amount of tax savings, you have to do certain things, and it may not be worth your time. You want to be careful how far you push that. In this case, are you going to go to jail? No. If there's a pattern of this sort of behavior, will it make an IRS auditor dig deeper? Yeah, I've seen it happen before, where they see something like this and think, oh, maybe everything else is kind of, well, as you put it, half-assed, and we can dig. IRS doesn't win cases as much on the deduction. Hey, you're not allowed to write off the car. Actually, you are. They win on lack of proof and lack of following the rules. Unfortunately, rules really are that you have to have a mileage log. And again, not hard to do with modern tech, but I get it. Not everybody wants to do it. In fact, nobody wants to do it. The question is it worth it for the amount of money involved? Looks like it's very small exposure for you, so you're probably not losing a whole bunch of sleep over it. I hear conflicting comments, a frequent thing. I have a homestead in Texas. Okay, now we're out of my area of expertise. So to be clear, I went and asked Claude Chat and double checked it. And I'm pretty sure my answer is probably right, but this is not my area of expertise. Based on what I saw and based on what I know, because 30 years of being a tax lawyer, working with real estate investors a lot, you start to run into a lot of non-tax concepts where you sort of have a clue. So is this expert knowledge? No. Is it, I have a clue and I'm probably right and I spent some time looking because I was kind of curious too. That's what we're talking here. So I have a homestead in Texas. I have a trust set up, but never moved the home to the trust. Frequent. I'm wondering which is best for tax purposes. I'm going to talk property tax, income tax. I don't think it matters. Move to trust, other assets. So if you move it into a trust, you have the trust. One of the things that the trust will do that a transfer on death deed won't do, because the idea is, I deleted part of this. The question involved, I want my child to have the home when I pass. I think I deleted that part. So what's the best way to have the child get the home, but also for tax purposes? Income tax wise, it shouldn't make any difference. From a Texas homestead standpoint, it may make a difference, and I'll leave you to look that one up. I didn't bother with it. I do think very likely moving it to a trust, you preserve the homestead exemption, both for asset protection as well as taxes. It'd be really weird if that weren't the case. What's the upside of a trust? It covers issues other than death. It covers issues other than death. So let's say you're incapacitated. What happens? Who runs the house? Who lives in it? Do you live in it? Who repairs it? Who has authority to do things? That's an advantage of a trust. Now I put template as a question mark because a lot of template trusts don't really address the incapacity issue well, and no one thinks it'll happen to them until, of course, it does. And then what happens? Now we have to go through court proceedings, much like probate. So if you're going to put up a trust that deals with what happens when you die, I don't think it's that much extra effort to go beyond the template and put in there what happens if you're incapacitated and defining incapacitated. Now, if you happen to have other assets, because we had a prior question of which assets belong in a trust to avoid probate. If there are other assets you have that should also go into the trust, now the trust really becomes my number one option here. You have one set up, you probably want to make sure it's updated, works locally under local law, deals with incapacity, but also allows you to put assets besides the home in it, assuming you want those assets to go to whomever. And actually that doesn't really matter because the trust can say to whom they go. Now, a quick and dirty method, if you just want to go cheap and easy, ignore the trust you have, not pay a lawyer to review it and deal with it, a transfer on death deed. It's cheap, right? So you have a deed that says it transfers to my kid or whoever I want to get it on death. It keeps the income tax and homestead benefits, but it doesn't address incapacity. You probably would want to have a durable power of attorney. Again, something, whatever your local state calls it, a lot of places, durable power of attorney that goes through, well, what happens if something happens to me? I'm still alive, but somebody needs to deal with it. So the transfer on death deed with a durable power of attorney is kind of the cheap version of the trust. I'm still favoring the trust, but okay. Add your only child to the deed. No, that would kill the basis step up. That hurts the child, right? When you pass, if the child was given a gift, the part that was gifted does not get the basis step up. So we want to have that. What's the basis step up? Let's say you bought for $10,000 and it's worth $200,000. You give half to the child now. The basis step up would have gotten them to the full $200,000, and now you only get them halfway there. And so if they sell, there would be a gain. So really, from a federal income tax standpoint, getting the full basis step up so that if they wanted to, when you pass, they could sell tax-free, you want to do the transfer on death deed, or you want to move it to a trust, presumably a living trust. Interesting, while I was looking at this, something I found, and again, you want to verify it, but interestingly, chat, and I looked up the answers. I don't trust it. So I actually went and looked at some articles written by local Texas lawyers, discussed how the Medicaid estate recovery program only reaches estates. It does not reach trusts. That's a hell of a glaring loophole and way to get around the Medicaid estate recovery program in Texas. So just something else I thought I'd throw in there. So I want to use my self-directed Roth to invest. I don't want the seller to know I'm buying in my Roth because the sponsor says IRAs cannot buy Delaware statutory trusts. And there are reasons for that, by the way, given how those are set up. I could see why the sponsor would not want that. It goes back to the same person had asked, why can't I use a checkbook trust for my IRA instead of a checkbook LLC? This strikes me as a decent reason to have a checkbook LLC or have a checkbook trust. In other words, if you recall, wanting to get around the custodian is not a good reason for a checkbook LLC. In fact, the tax court has made very clear it doesn't like that. Asset protection is a legit reason to have a checkbook LLC. And I suppose if you wanted to invest in things and not have people object to your investing in those things, then the checkbook LLC or a checkbook trust would be one way to do it. But you have to think about my comments on the McNulty case and alternatives of how to avoid the McNulty problem. For example, you could have a manager or a trustee who has access to the bank account and you don't. Because remember, my issue with the McNulty case is that if you have access to the bank account, you can just write checks, then you have complete power over the bank account. Well, what does that mean? IRS can argue the bank account should be distributed because you have constructive ownership of the bank account. You could write a check to yourself or to whomever you wanted. Whether or not you actually do so doesn't matter. You could. That is constructive receipt. And I think it sets it up for an IRS argument that, well, if you have constructive receipt of the cash that passed through there, they could distribute everything. Have they done it? No. Could you gamble, bet on that they're not going to do it to you? Or if they do it, maybe they give everybody time to get out of the arrangement. And they have done that before. There have been cases where when the IRS makes a ruling on something very broad that affects a lot of people. There's a case, for example, where the taxpayer loses, and there are a lot of taxpayers in the case. Sometimes the IRS gives a grace period to unwind the arrangement. So I suppose if you're going to have a checkbook LLC or trust, in spite of my recommendation not to, you can either do it in the normal way, which is easy, and it's the way you've got it, and it gives you what you want, and it makes you happy. But there's a risk. If you're the one that gets audited, and the IRS finally decides to act on what the tax court said in McNulty, you may have a problem. On the other hand, you can bet that they're not going to catch you, and if they do, they'll catch someone else first, and they'll be very forgiving and give people time to back out of these arrangements. I tell you the legal part, and I'm telling you based on the McNulty case, checkbook LLCs, checkbook trusts, I think as constituted can be unwound. What's the problem with putting someone else in charge of the bank account for either the trust or the LLC? With you not being in charge, they're the only ones who are allowed to write checks. You don't have that power. You actually make on the bank account, they're the sole signatory. You don't have the power. It's not enough to write a piece of paper that says, I don't have the power. I'm forbidden from doing that. No, you actually have to lack that power. Well, there's a trade-off. Now some other human has the power to do it, and they may misuse that power in a way you don't like. And so there are always trade-offs. Just telling you what I think McNulty says, you can decide on what the risks are if it's worth getting what you want.